Okay, so my name is Marco Becht. I'm a professor of finance at Université libre de Bruxelles, and I'm the Leo Goldschmidt Chair Professor of Corporate Governance. And we set up ECGI 20 years ago in 2002. And one of the reasons was that people were talking about corporate governance in the United States all the time. But corporate governance in Europe is just so much more interesting because it's so much more diverse. And countries have their own systems, they differ from each other, and you can actually compare. And Sweden, of course, is one of the countries that has a very interesting corporate governance system with all its specialities, the control structure with dual class shares, people being investors, be the largest investors being on the nominations committee, and the whole Swedish corporate culture in general. So people were very interested in this, and it's been quite a success, and it's grown, and it's now de facto a global network with more than 300 researchers accredited who produce research all the time. Now, SCHOFF is a member of the network as an institution, but also the researchers of SCHOFF, many of them are accredited ECGI researchers because of the quality of the research that they do. And if you look at all the places in the world that are kind of blinking as important places for this topic, SCHOFF is certainly one of them. And there are many reasons why SCHOFF is such a leader in the field. The most important is, of course, the quality of the researchers who are here. Many of them are world leaders, world class, for a variety of reasons. So that's a credit to HHS as well, to have managed to attract them. But it's also the environment. Sweden and Stockholm have the advantage of having pension funds. I just spoke to somebody from AP7. Other countries just don't have that. That then creates a culture of asset managers, industries around. You have, of course, NASDAQ, OMX. So there are a lot of things. There's private equity in Stockholm. So there are a lot of things that come together to make HHS and SCHOFF a really vibrant place. And then, of course, since you have this little thing called the Nobel Prizes, or actually the Riksbank Prize, scholars from all over the world love to come here because they think it might just improve a little bit their chances to win the Nobel Prize. So convening power is also there. So what can I say? It's just a great place to be, and people are extremely welcoming. And ECGI has done lots of things with SCHOFF and HHS, and it's always been fantastic. So the study I'll present tomorrow is about Standard Life Investments, which was the largest active manager in the UK between 2007 and 2015. And it's about their engagement program, in particular the private meetings they had with their portfolio companies. Now, what's special about the research is that for all the meetings that they had, which is about 5,000 altogether in that period, we have the meeting notes. So it's not, we don't just know that they met with a company, but we also know from the records what was said at these meetings, and that's what we analyze. Now, corporate governance researchers are very interested in what the outcome of these conversations are. We document that that is actually not the only thing that is going on in terms of behavioral change, but actually the active manager also gets a benefit from these conversations because they get a risk assessment on the particular company. So if they spotted a problem, for example, in the governance conversation, they would communicate that to the fund manager. And because we had the holdings of all the funds that Standard Life managed, we show that actually the fund managers acted and traded based on the information they got from the ESG function. Now, that doesn't sound very surprising, but it is, because if you look at the literature, people normally argue that ESG information is being ignored by fund managers. We show that already in that period that was not true, and actually ESG information is very important. And I'll show you one particular example that people enjoy very much, where they go into a conversation in December in a town close to Birmingham. You have to imagine it's as dark as Stockholm outside. And they meet the chair. They were worried about the company's performance. And the analyst notes that the man was unfeasibly tanned for the time of the year because he'd just come back from a trip to South Africa via a spa in Thailand. And he was a busy man and basically didn't know what he was talking about. Okay, so that information was given to the fund managers. The fund managers sold down the position, and actually in this case the company went bankrupt, in the next year. So that's an example, but we show in the paper that this actually holds for the whole sample. It's not just an example, it's a sample property. So the ESG function managed to get this information, risk information, out of these conversations. So it's soft information, and the fund managers traded on it, and they did so profitably. So why are these meetings important? From a corporate governance perspective, they are important because they allow engagement and dialogue. So if you want to influence the behavior of a company, you want to do that really in private, because you can express views that you can't express in a shareholder meeting or in a conference call or an investor conference. So it was mentioned today about voting outcomes being surprisingly homogeneous. Well, that can be a failure of engagement, but it can also indicate a success of engagement, because if I'm not happy with something, I talk to the person, and then if they agree and we resolve the conflict, there's not going to be a controversial vote. So having these conversations in private is very important, and from a corporate governance perspective, that's why these meetings are important. Now, there's a second reason why these conversations might be important from an active investor point of view, which is that it allows you to make assessments about your portfolio companies. So you can assess, for example, the quality of the management by meeting them and by talking to them and figuring out, for example, how they respond to your questions. So if you discuss last quarter's earnings announcement, and you're worried about these earnings because they were not very good, you quiz the management. They don't need to tell you anything new, but already the way they respond to your question can tell you a lot. And we show in the paper that that is actually valuable information that the fund managers use. So that's another benefit which contributes to market efficiency. Now, the question that raises is, where do you draw the line? What kind of conversation do you allow to happen in private, and what do you consider non-admissible because it amounts to insider trading? And there Europe has good regulation. It's called parity of information system. So you are not allowed to discuss material non-public information, but you can have these discussions based on hard information and gather soft information. And of course, enforcement is important. In the UK, it seems to be what we see quite good. But of course, if you allow these meetings, there's always the potential that private information is being passed to the investor. So there is a risk of insider trading. And that, of course, is a question, where do you draw the line? How good is the regulator? How good is the enforcement, etc.? But, it's a trade-off. And I emphasize the benefits of these private meetings before, and where you draw the line, that is in the end a policy question. So what are the broad implications of the finding? Well, the findings themselves show that these meetings are important, but I also, and this is a personal evaluation of the findings, having read a lot of these meeting notes, okay, with the help of a large language model, so I haven't read all of them, but we certainly sampled many of them. They do show to me that the power of meetings and of private engagement is there, but it's also limited. So these private meetings, private engagement is no substitute for appointing people to the board. So appointing the right people to the board, holding the people to the board on the board accountable is really fundamental. So this fundamental property and issue in corporate governance is really central, and in some sense this research about private meeting confirms that. So direct shareholders governing a company as a group, that really doesn't work. So you need to appoint the right people to the board. And of course, Sweden, with its nomination system in that sense, I think is exemplary, with shareholders participating in this process actively. And again, Sweden could be an example for other countries also in this regard. Okay, so what are the biggest challenges in corporate governance at the moment? I see the biggest challenge coming out of the US. And corporate governance and the whole topic of ESG being politicized. And there is a deliberate confusion between ethics and ethics-based positions that people take and ethics-based investment decisions and risk-based investment decisions and risk-based engagement, which any asset manager should be doing. And in many ways, ESG and corporate governance is being weaponized together with antitrust in order to prevent asset owners and trustees of asset owners and asset managers to do their job, which is to manage risk. So there is tension here, and we will have to see how it plays out in Europe. But at least in the United States, we are seeing a lot of that still. And we'll only find out in the next few years how that plays out.